Hi everyone, I'm Güllüoğlu. Welcome to another episode of Market Update featuring by Market Soul and Rationale. Before getting into this week, market pricing were shaping around four different headlines: earnings, the Fed rate cut narrative, US presidential election, and the Bank of Japan hawkish stance and its potential implications. This week, with the Japan market opening, huge volatility welcomed us. The Fed rate cut narrative and the Bank of Japan's hawkish stance started to be effective, and we witnessed a significant sell-off in global equity indices and currency pairs that offer carry trade opportunities. So we have seen increased recession expectations, particularly after the Friday Nonfarm payroll data and dovish tone of Fed side. According to the CME FedWatch tool, as you can see in this chart here, the market is currently pricing 4 or 5 rate cuts until the end of 2024. Here, as you can see, the 4 and 425 range indicates like a 5 rate cut, and it's the probability of it is like 44% right now. As you can see, considering the current environment and current pricing, increasing rate cut probabilities doesn't always like lead to risk on pricing. There are also talks that Fed might make an emergency rate cut without waiting September meeting. I think that will be devastating for the market, as it would signal that things are much worse than they seem. An emergency rate cut would send a message to the markets that the situation is like a very bad. Like instead, like if there's a need for US liquidity, the Fed could intervene there like with different policy instruments. They might reduce the amount of quantitative tightening or like a pause it for a while. Those might be another like different way to intervene in the market. But emergency rate cut would definitely give very problematic signals. So there need to be like a gradual rate cuts, which would ensure the base scenario of soft landing in order to see positive pricing on like a risk on instruments such as like equities or cryptos. And like on a related note with this mentality, with rather than having like a 5 rate cuts expected, because 5 rate cut means on like probably September there should be a 50 basis rate cut, and on November same as well. And I mean this is so unusual. Rather than to see like such aggressive rate cuts, to see better pricing, like positive pricing, or getting back to like a bad data, good pricing situation, there might be like more like a gradual, more balanced actions should come from Fed. And related to this one, Chicago Fed President Austin Goolsbee mentioned that although like a Friday's U.S. unemployment data was weaker than the expected, it doesn't indicate a recession. However, Fed officials need to remain aware of changes in the environment to avoid being overly restrictive on interest rate. So this statement actually came just after Monday's huge sell-off, suggesting that Fed like doesn't see significant issue in economic activity like warranting like aggressive rate cuts. It felt more like a bit like a calm down guys kind of message from Fed, because like there's not like a big deal going on the like we just see just a monthly non-farm payroll data and still coming in positive side, still US economy creating 175k of like job like employment. And I mean currently it doesn't seem like that much catastrophic, but yeah, I'll come up to some other points why this kind of pricing we saw in the market. So here in this table, you can see the change in the rate cut probabilities, rate cut expectations of market participants. How did it change? As you can see, just in a week, the 5 rate cut here in this 4 to 425 target rate currently is 44%. A day before it's 47.8%, and the week before it was like a 0%. It's like a huge change, And yeah, like here in this chart, you can see this is SOFR future chart, 3-month SOFR future charts that I've been like mentioning a lot in our market update videos as a tracker that the potential rate cuts. Just to recall, like an increase in this chart indicates an increase in demand on treasuries, and that will mean a decline in treasury yields. So we had discussed this consolidation here. As you can see, there was a really nice symmetrical triangle chart pattern, and I had mentioned this, a potential breakout from here would be an indication that, okay, market will be more like a down to more lower interest rates, and it happened here. And this, as you can see in the rectangle, the highlighted area is weekly move, and with this weekly move in this table we saw this weekly move. That's why I want to show together. Yeah, apart from this, like a US side, this all the ongoing recessionary risks, the impact of Bank of Japan. So the to mention again, 4 important headlines: earnings, presidential election, Bank of Japan, and Fed rate cut narrative. As you can see, like currently what we're having is Bank of Japan and Fed rate cut narrative. After the Fed rate cut narrative that I just covered, like the impact of Bank of Japan's hawkish stance is becoming evident. We have been experiencing the rapid consequences over the past 2 days of like unwinding leveraged investments in high yield assets funded by Japanese yen borrowing, driven by Bank of Japan's rate hike and like a swift appreciation of yen. Just to simplify the story, actually, we can say that the Japanese investors who hold like very significant amount of foreign instrument returning home as they see more tightening in the spread between US yields and Japanese yields, because they're like what they do is generally they were borrowing from in like a Japanese yen, and they were converting it to USD. Probably they in order to hedge it, in order to fix the spread between Japanese yields and US yields, they were paying a premium to like exotic instruments or some options and stuff to fix that difference, because with that otherwise they would be taking currency risk. In order to avoid currency risk, they're doing like options and stuff. In the case of like the yields, the spread between yields tightens, the premium probably gets more expensive and it loses attractiveness. In that scenario, why would I do like that carry trade? And I'll come up and show you like the one of the biggest like carry trade that was going on through yen was, for example, Mexican peso and Japanese yen. I'll show you the chart of that currency pair. And just to wrap up or like summarize the current situation, I would like to show you the relationship diagram. As you can see here. So first of all, it started with like a dovish tone of Fed here, as you can see. Then Bank of Japan rate hike with like their hawkish stance, increased Japanese yield. On like in the dovish Fed with weak Nonfarm, lowered US yields and increased recession risks. And as a result, like spread between US and Japanese yields tightened. And as a result of that, heavily crowded carry trades against the Japanese yen started to be less attractive and unwinded, and with increasing recession risk. So risk of sentiment also led to sell-off in equity indices. Now, like as you can see, this part is the reason, and as a result, we saw huge sell-off in equity indices and currency pairs related to carry trade. Now the question is like, what's next? So we need to carefully watch if the US earnings season can counteract the effects. The US earnings season is one other headline that I was mentioning and within these four major headlines that are effective in current pricings. So we need to carefully watch if the US earnings season can counteract the effects of US recession and Bank of Japan's hawkish policies pricing. One of each of those major headlines will counteract in the following days, and let's see which one will drown out the impact of the other one. At this point, the performance of regarding to the earnings, S&P 500 companies relative to expectations continues to be a bit mixed actually. We had received some good earnings, but the market didn't like that much because the benchmark was set so high. On one hand, the percentage of S&P 500 companies reporting positive earnings surprises is above average according to FactSet, which is good sign, which is good. But the question is if it's sufficient or not. Especially following such a bull run, after a bull run, because since the expectation is set so high, as I mentioned in our previous markets all video, I had discussed this that will be challenging for equities to exceed expectations, current expectations in Q2 earnings season, given the analysts' projections remain so high. So as a result, even strong earning reports might not lead to significant positive surprises and buying, but we're gonna see if the buy the dip scenario will work after this, or if we're gonna see more correction, or if we're gonna get into a bears market. But it's questionable if the earnings can counteract the impact of the US recession probabilities, so-called soft landing and versus hard landing discussion. So in general, as we diverge from the soft landing scenario, that will be bad for risk on instruments, and we should watch carefully economic activity related data in the upcoming days, and if we're gonna see if this will lead to buy the dip scenario rather than extending correction. So before getting into some charts, major charts, I would like to show you some highlights of this week. Remember that the bad data does not lead to good pricing anymore. So ISM number this week should be watched accordingly. In terms of data, inflation-related data started to lose its importance. I'm not saying that it's not important, for sure it's important, but it's always relativity. Relativity is there. So relatively economic activity data, economic activity is more important. Also on the China side, still growth concerns on the table. Still the steps taken by the authorities have not resulted in concrete results. In such an environment where the concerns around economic activity, especially industrial commodities and oil, are expected to perform poorly. One other point to watch is potential upturn of Eurozone inflation, considering the recent data flow. So for this week, it doesn't seem like there are a major data flow, but ISM data is pretty important. First of all, let's start with USD-yen. I'll show you a different perspective on yen actually. Okay, we all know this huge sell-off in USD-yen, but when you come to monthly charts, you can see that huge price action going on there. This HNS bottom, breakout, pullback, and it's moving. If I wouldn't tell you that this is a monthly chart, you will say probably that this kind of correction here is pretty normal actually. But current environment, that doesn't say that doesn't indicate such thing. But just showing, also just to put some different perspective. But in the daily scenario, let's see where we in the moving averages. As you can see, we lost like 200-day moving averages. Probably like first support will be around 140 levels. Apart from that, when you come to the in the monthly base, as you can see where we see the rejection is pretty critical area of the 160 levels. And yeah, like for this chart, as long as it comes, I mean, it moves like this much of this kind of directional, I wouldn't be trading such thing, because I would like to see more consolidation and more like to see like consolidations like here, for example. As you can see, it worked pretty well here, this ascending triangle after a downtrend. Nice move, pull back and move really good. I would like to see like such consolidation around here in order to get in. And I would like to show you this I mentioned about this tightening tightening spread between US yields and Japanese yields, and this is a 2-year spread. As you can see, since Tuesday, after the Fed meeting, you can see the huge sell-off here. This is around like 8% spread tightening, and here there's like a consolidation here, and if we lose here, that might lead to more major movements. Maybe like, okay, I mean, if there is more about the carry trade side, we might see more on unwinding carry trade activities. And this is the 2-year version. Nothing special, nothing different between. Yeah, and this is makes it look at this. Like you can see this how like through this, like I don't know how long since the COVID actually. You can see the how it worked. Like since like a Mexican peso is like a developing country, they actually managed really well during the tightening of developed markets. They stay like they had really high rates, and they offered opportunity for a carry trade in order to protect their currency, and it worked pretty well. And it also provided an opportunity for a carry. It offered the carry trade, and what I was watching in this chart was this rectangle chart pattern. It worked out actually. It broke out, then came back. There was a huge sell-off, but it reached its rectangle chart pattern price target. But with this like recent activity in carry trade, we experienced a huge sell-off here. And same in Aussie USD. And also Aussie USD is perfect indicator for me just to evaluate if the current environment is risk on or risk off, because Aussie is exporter country of industrial metals, right? And in order to like if the economic activity in general in the world is doing well, China is the, let's say, the engine of the world. China will be importing from Australia. In order to import, they need to demand Australian dollar in order to buy something, right? In that scenario, if the economic activity is good, they need to buy industrial metals. In order to buy industrial metals, they need to demand Australian dollar. And if they demand Australian dollar, that means that, okay, risk on, economic activity is good. But Japanese yen, with the given like a very low rates and like a consistent economy, like a big economy, it's so risk off mentality. So in order to evaluate the current situation, you can monitor Aussie yen currency pair as a risk on off indicator, just as a reminder. And the XY, if you keep watching our like a market update videos, I mentioned this weekly, this symmetrical triangle chart pattern forming here. But in order to see potential continuation on this chart, we need to see a rejection from here. Okay, daily basis, we saw a rejection here, but we need to see like action like this, because in that scenario that will be like first touch and second touch, and we might see continuation as a like a third touch and a breakdown. And I'm waiting for it, and in order to like confirm this symmetrical triangle chart pattern. That's how I track the XY, and like we owe this huge move for sure the USD yen movement, and we're below 200-day moving averages. That's another important supporter of a potential symmetrical triangle, acts as a downward like a continuation, and yeah. And here also I had mentioned this S&P 500 chart, future chart. This I had made this stage analysis here, and here, as you can see, I mean, it's not a really proper one, but like you could consider this HNS top formation. And generally in the accumulation phase, after the accumulation phase, which is called stage 2, we need to see some consolidation phase, as we see, sorry, distribution phase, as you see here. Then a bear market comes, and here if we see further decline here, and how much we're done from the top currently is like a 10%, a little bit more. This is still considered a correction, not a bear market. In order to say like a bear market, at least we need to see like at least 20% decline from the top. But yeah, if we see like a potential continuation of this decline, we might say that like this part is distribution like a stage 3. That's why I put question mark here, because maybe we're gonna see a rejection from here and continuation, because in the S&P 500 we're still above the 200-day moving average, and thus we'll see the continuation of the price. And Nasdaq, unlike the S&P 500, we saw the 200 below 200-day moving average. I was following this channel. It broke down. Generally, you need to mirror the channel in order to see the price target. It almost touched the price target, but I don't know. Yeah, generally I prefer like a horizontal chart patterns rather than like a channel. But it's good sign that 200 moving average is acting as a support here, and for sure this level will be crucial as well. But yeah, and also crude oil, as I mentioned just before, in an environment where the economic activity is suspect, like is like a, in an environment you question the economic activity, you would expect oil to perform poorly, as like because like in the expanding economies they need oil and they would demand. And like this chart is pretty like similar to the XY, and it actually, I mean, you can call this as a symmetrical triangle chart pattern, because first touch, second touch, third touch, maybe fake breakdown. We'll see. We'll keep monitoring it, but we're like below 200-day moving average, and yeah, a potential like a breakdown from here. A short trade idea might be executed in the oil. Let's say, just as an example, is a short trade idea with a stop just above here, maybe a bit like a wide stop, but if you target here, it gives 1/1 risk reward ratio. Personally, I don't prefer such thing. Generally, I'm trying to do like a play with like a tight stop loss. Like for example, here acted like that, like acted as a minor support, maybe, like, because in general, like there is no like a right stop or like a right take profit. It's all about your risk management. It's all about your current market portfolio. In order to put like a tight stop or like a wide stop, it's all about your expectation that you want to wait more, or you want to be like okay, if it doesn't work, let's move on. Like in that scenario, you would go for a tight stop. And here in this, if you just like target here, let's say here, this would offer you 1 over like a 2.7 risk reward ratio. And Bitcoin here, and also here to see a rejection from this area, because is like at least it's something, because it's not a proper one again, but you might consider this as an HNS. It's not a proper one. I'm not a fan of it, but yeah, at least like you can say that the old resistance might act as a support here. To be honest, like considering the long duration of AI stocks or cryptos in such environments, I would be following all these instruments, a potential like a buy the dip formation. But it doesn't mean like, okay, if it, I mean, Bitcoin acts like this, I mean, let's try to catch the dip. I want to see some like low risk entries to be set up in order to get back into all these instruments. Here in Bitcoin, I don't see such thing, but I'm like, I would like to see some further consolidation. Maybe down here, it might act like a small consolidation, and I might give a shot. But currently, I don't see anything on Bitcoin side. And gold, actually, people are asking like, where like I would also like to show you real rates. Actually, yeah, gold side. Let me finish the gold first. Like in this kind of environment, when the rates are like coming that much down, and risk of sentiment, political environment is so bad. I mean, why gold is not acting like why gold is like, I don't know, 1.20% down now. As you can see, first of all, short-term moving average is holding the gold price. But the thing is, in generally, when there is a leverage, positions are closed in due to any kind of situation, as we are experiencing right now, in like they have a leveraged yen position, and it's like due to leverage position, there were a lot of like a margin calls going on. And in general, in these kind of scenarios, big funds generally, in order to hedge their risk on portfolios, they have like a huge also gold portfolios. And in order to like compensate that margin calls, they're selling golds. That might be just one reason. Apart from that, treasuries, they might be expected to get much lower, and the current yields that are offered by treasuries might come so attractive to the investors, and rather than getting nothing like as a constant yield in the gold, they might just directly go to like yields as a risk off instrument. And that's another explanation for like gold side. And yeah, it's not like a really complicated days in trading right now, but I still believe that like in the like semiconductor side, huge sell-off. I'm not saying that they came like they came really down, like just buy, but I would be like just started to like I mean I might try to start to position a bit on that side. And also gold, I still expect the continuation of this huge movement here after this head and shoulder continuation chart pattern. I don't know, my line is gone again. Sometimes this is happening. And yeah, that's all I'm gonna talk about this week. Like thank you for your time and listening. If you find like these videos helpful, please like give it a like thumbs up and like subscribe to our channel. That means a lot for us. And I hope you have like a really good week, and good luck with your trading. Have a good one. Bye.